Hey, everybody. Welcome back from break. And this panel is about private assets. And what we're going to do is talk a little bit about what the heck is a private asset, and then how do they fit into an ETF. And then we'll also talk about what is next, what's coming down the pipe here. Now, so just to start briefly before we get to intros, what is a private asset? A lot of people would say, well, a private asset is just something that's, private. Okay, what does that mean? Something that is not listed. In some cases, it's a security that isn't even registered, right? If you really want to go broad on it, my son's Pokemon card collection is a private asset, right? So there's a lot of things that fit into private assets. Thanks to megaphones on the internet, we are well aware of some of the failings of certain types of private assets. We're not really going to get into that today. So anyone who wants to storm the stage on valuation and real estate and how everyone's getting, Schrodinger valuation because they don't look at them, that's for another panel. Okay, so why don't we start off here with some intros. Again, Mark Apsey, All You Can ETF, about 30 years in the industry, focusing primarily on indexes and ETFs. If you've ever heard of or traded ETFs like Sky, Fan, Hack, iPay, Gamer, basically, I'm the guy that built the initial indexes for those. So I'm an index guy. I build indexes. I help people get their investment strategies into indexes and then help them get their products to market. So that's enough about me. Jim, why don't you take it away?
Hi, I'm Jim Palmieri. I'm a managing director and senior portfolio manager with State Street Global Advisors and their active fixed income team. I have nearly 30 years of experience. I've been with SSGA for 9 years. Our active fixed income team manages active fixed income with all the wrappers, whether it's a separately managed account, mutual funds, or ETFs. And on the ETF front, our desk manages an ultra short-term ETF, ULST, bullet share, muni, and corporates that are actively managed with my income. And then, of course, the public and private credit investment grade ETF, PRIV.
Tom Merritt. I'm the founder of OpenVC. We're bringing venture capital investing, late stage VC to more investors. We were founded, we're relatively new, not as old as State Street, 3 years ago. We're backed by Intercontinental Exchange, ICE, and we've partnered with them to launch indices in late-stage private venture capital assets. So we've launched the New York Stock Exchange Open VC Index, which tracks the 50 largest private venture capital-backed companies in the US. And we've also developed these indices which are priced on a daily basis. So Open has created a pricing network where we are valuing and tracking the value of all of these private companies and producing prices on a daily basis fitting into the index. We're also an asset manager. We've just launched our strategy tracking the 20 largest private companies in a private vehicle.
And I'm Rob Nanny. I run business development at Templum Inc. We are a fintech platform focused on providing market infrastructure in the private markets. We enable access to various private equity, private credit, venture, real estate, different types of investment opportunities, and we'll provide end-to-end technology solutions that enable primary issuance and secondary trading solutions for broker-dealers, RIAs, TAMP platforms, essentially all of the workflows you would need to participate in the private markets. And just to make my compliance team happy, all of the opinions that I express here today are solely my own and not the views of Templum or our affiliates.
Excellent. And anybody else want to follow up on that? Jim, Tom? No? Okay. So one of the things that I like to do in my writing and when I'm talking about ETFs is not just say, hey, here's an ETF and it does this, and wouldn't it be great to look in your portfolio? I really do like to figure out how these things work, right? Because in as much as people like ideas and they like new product, like what does this thing do? How is it different? Why should I pay attention to this, right? What's my catalyst here? So in that vein, I'm going to start off with Jim and talk a little bit about Priv. Now, clearly, 4A2 securities, 144A securities, these are not new security types. Priv isn't the first fund really to incorporate these in it. So can you talk a little bit about kind of how Priv is different from previous iterations of these funds? And I know there was some noise made about Apollo being a partner, and perhaps you can talk about that as well.
Sure. So why don't I just talk about why we did it? Why did SSGA and Apollo enter into an agreement, and that part of that agreement is PRIV. And so, there's four things we think about. The first one is that, depending on your definition, the private credit markets are just too darn big to ignore. Apollo's definition is broad. They see it as a $40 trillion addressable market that cuts across not just direct lending to middle market companies, but it's really taking advantage of the different access they have to the private markets through their high-grade capital market solutions, the entire ABF suite of products that cuts across real estate, consumer, hard assets, equipment, and esoterics. The second reason, well, okay, great. So why? What's the value proposition? For us is still significant risk premia that you can get from the private space versus public. The simple numbers are the Bloomberg corporate index has a spread of about 100. BBB part is about a little over 100. Our BBB plus rated book that we've sourced from Apollo has a spread just under 300. So I think there's significant value there. I think democratization through the ETF wrapper is a big part of why they got together, obviously leveraging SSGA Spider ETF platform and wrapper to introduce this exposure. And I think the innovative solution around having over time potentially an even more robust exposure to private could definitely is coming from the liquidity backstop arrangement that we have contractually with Apollo. I think that's very unique in the marketplace. So ultimately, we see Apollo as this very unique dealer with very unique supply. They're giving us risk premium from complexity and liquidity premium, not incremental credit risk. And I think it wraps up with liquidity backstop into a product that offers an ag replacement or even a unique core plus alternative with a unique plus that can generate competitive performance and a smoother ride.
Okay. So clearly Apollo is essentially acting as a kind of a dealer plus. What's your response to folks out there who might say, oh boy, how do you know that you're not just getting the stuff that Apollo doesn't want, or that kind of thing? How do you counter that?
Yeah, the adverse selection concern out there. The partnership is above and beyond just this one ETF, just to be clear. There's other interactions and products that are already out there with both Apollo and SSGA. We've been at this for almost 2 years. We've seen their inventory. We have access to every primary market issuance, whether it's ABF or the high-grade capital market solutions. And for all the assets that are currently sitting in PRIV, in particular the 4A2 corporates, those are all secondary transactions that we got access to. And I think what we did was basically find the right connection point between our credit research team to make it clear we're the fiduciaries, we're making choices as to which assets come in at the level that we deem is appropriate for the risk that we're taking for the fund. And so it was more about fit. We've seen it all. We know where we kind of sit with each other in terms of fit, in terms of product for high-grade capital market solutions and ABF. And we're seeing every primary market dealer coming to either market internally or externally.
Okay. And then again, when we think about private assets, and I alluded to this earlier, one of the issues that has come up, well, two of the issues really focus on liquidity and focus on price discovery. And you mentioned that you have kind of I wouldn't say a deal, but I mean you have an agreement with Apollo and backstopping certain ideas. But can you talk a little bit about pricing and price discovery? I mean, is Apollo just marking its own paper here? What how does that work?
Yeah, so it's a contractual agreement. So just to be clear, and the way it works is for every private credit asset that we source from Apollo, we get 3 quotes a day, both sides, executable within 15 minutes. The way we use it with respect to an ETF is that 7:30 a.m. quote, we actually use the width of the markets that they're offering to us to establish our variable fees for that day for the ETF, which I think is also a novelty in the ETF world. And so from our perspective, we have a variety of things that I think are really constructive in terms of price discovery. We don't get just 1 quote, we get 3. You get the first one. We have the independent valuation of all these assets from the night before. We have the markets and economic data and things are in motion. We get a second quote late morning and then a third in the afternoon. And so from our perspective, because it's a contractual agreement, we're getting all the bits of information we need to know as to where the asset would trade and where it sits with respect to our perspective of relative value, not only from the perspective of the markets that they're making. A lot of the ABF assets, we can see the markets away, but versus our valuations that we're getting every night to strike the NAV.
Okay, and then actually the liquidity and valuation question actually provides an entree to Tom and Rob here. Don't worry, we still love you. But Tom, can you talk a little bit more about the index? And when I say that, I mean operationally around pricing. I remember, I don't know, a decade ago, back when Second Market was still called Second Market, we had some conversations about potentially creating kind of a 40 Act or a 33 Act product with pre-IPO shares. And at the time, frankly, the only structure that would accommodate it would have been an interval fund, because liquidity points were maybe weekly, I think Facebook was doing weekly liquidity at the time or something. But can you talk a little bit about how easy or difficult it was to A, find venues, and then B, what kind of consistency and quality you're seeing in those quotes?
Yeah, sure. So this is something that has developed really in the last sort of 3 to 4 years. The secondary market for pre-IPO companies, has its nascent beginnings back in Second Market and other things years ago. But really, volumes have not really come to this space until sort of post 2020 is where, in our historic data, that's where we see trading volumes picking up, the market cap of this space sort of really accelerating. And that's been due to a number of factors. One is companies are, there's been a lot of venture capital money raised privately that has been funding these companies. And the second reason is these companies are staying private. These companies are not exiting, and this asset class is just growing and growing and growing. And so that's what's really driven, I guess, the need for investors, for employees of these companies to actually get some liquidity. And that has really started to build these secondary markets in this space. It's our index, which tracks the largest 50. Obviously, there's a significantly bigger number than that. The largest 50 is a $1.3 trillion worth of market cap just in the US alone. So if you look globally, it's orders of magnitude, it's multiples of that. But it's a really significant asset class that investors do not really have access to. And that's what we want to change. So in terms of pricing, When we founded the company 3 years ago, we wanted to bring democratized access to this asset class. We wanted to do it in a way that was low cost and passive, which is very different to the fee structures that are currently in this space. Really the only way to access this asset class at the moment is through the growth funds or the VC funds charging 2 and 20. It's a very expensive asset class to enter. That sort of probably made sense 10 years ago and makes sense when you're a small asset manager trying to find, these out of distribution successes as a venture capitalist. Now, these are some of the largest equities in the world. Our top constituent in the index is SpaceX. That would be in the top 20 of the S&P 500. It's worth over $360 billion. OpenAI is at a similar valuation. Again, would be in the top 20, top 25 of the S&P 500. And these companies are not in any of these indices. So that's sort of why we believe that there's a lot of interest in democratizing access to this. In terms of pricing, what we did was we looked at the space. We wanted to find an index that we could invest in. There were no indices. We have a great relationship with the New York Stock Exchange and ICE, their parent company. And so we partnered together to actually create this family of indices to track this asset class. Again, there was no consolidated pricing, and so we set about building a consolidated pricing platform to determine the market price of these securities. We integrated across a number of partners, quote, order book data, and executed trade data to create this consolidated tape of these transactions happening in secondary market, and also primary issuances where these companies are raising primary capital. We then developed an evaluated price, which takes all of this data into consideration, which powers the index on a daily basis.
And Rob, you're next, I promise. But so question for you, and you kind of answered it in your last comment, but so as these shares trade, they get prices, they get valuations. What happens at the point where a company does another round or does another raise, and it, of course, is going to be different. It may be higher, maybe lower. Is that just a hard set to that value then? Or how does that work? And I know we'll talk a little bit more about this in the next 32 minutes. But what would that do to a potential pooled product, which is saying, oh great, I own SpaceX, it has a valuation of 390 billion. They do a raise, and all of a sudden that valuation is 370 billion. All right, and I know there's all kinds of considerations, legal and otherwise. But I don't know, just any comments on that, or at least on the mechanism of kind of regular way trading, price discovery, versus, okay, now the company's done a raise and there's this kind of hard stop on what the actual value is.
Yeah, that's a great question. We're trying to determine the market price where a willing buyer, willing seller would transact this, this security. We see a primary capital raise as sort of a singular data point. That is a trade. There's many trades happening. There's trades, in the secondary market. There's the primary trades, and it's just one of many. So considered amongst them all.
Okay, and then Rob, can you talk about what you've been seeing? I know in our pre-call, I had asked you if what your company is doing is analogous to maybe ARCA 20-something years ago, where you're kind of lighting up darker markets. But if you could talk a little bit about that.
Yeah, absolutely. So just taking a step back for a second, I think the main thing that you'll see, especially in the equity sides of the private markets, is a lack of infrastructure, a lack of connectivity, and just bifurcated parties. So whether it's private company shares that you're looking at, limited partnership interests, you're going to have essentially trading desks at various different firms, that are collaborating with the market. And a lot of this is phone brokered over email, where folks are trying to find who has supply, who has demand, and then, make a market and close a transaction for your client. You could also build strategic relationships with, different asset owners, et cetera. But again, all of this is really manual. So when we look at liquidity in the space and where we think things are going, is we need some sort of standardized infrastructure layer, so that whether you're looking at LP interests or private company shares, again, you can have a central location to go to that's aggregating essentially the order books of all of these different trading desks that exist. And you can now get data feeds, and companies like OpenVC are doing this already, where they're starting to aggregate the different order books that exist and get that data front and center so people can make educated decisions. The next step forward is being able to transact and actually enter in a trade or execute agreements to close a transaction in a more standardized format on a platform where you can go one to many to various different brokers or buyers or sellers directly.
Okay. And then to carry on kind of the trading conversation, Jim, I know you mentioned, I forget if it was earlier today or what, but that about 20% of the portfolio is in kind of Apollo source paper. What are you seeing in terms of kind of dealer networks with regards to the private asset paper, or is it strictly that you're kind of transacting with Apollo, or kind of how does that work?
Well, I guess I'd look at it by taking the private credit exposure and breaking it into two pieces. I think there's the ABF part of the equation, and those are QSIP 144As. And so multi-dealer quotes is certainly possible. We are getting two-sided quotes every day from Apollo on those assets. And I think that's something that is a source of stability there. I think the 4A2s is where I would describe us in the very early stages of an ambition of Apollo's, which is to really create a trading ecosystem for investment-grade private credit. I would say within the book, what we're seeing are what I would describe as green shoots. So, for example, we have 4A2 corporates, where obviously we're getting our two-sided markets 3 times a day, but other banks are connecting with Apollo and are able to, as a result, offer us levels as well. And so to me, I think that's kind of where things are headed, that it could be a case in which a year from now, maybe even 6 months from now, we'll have multiple quotes on a lot of the 4A2 assets. That just opens up the possibilities from the fund from an objectives and constraints perspective.
So in kind of layman's terms, you'd say that Priv is more cutting edge as opposed to bleeding edge in terms of liquidity pricing and overall exposure?
I think so. I think the agreement we have with Apollo is totally unique. I've been trading structured credit, and boy, the liquidity can kind of come and go on that stuff. And with your average typical relationship with any dealer is you acquire the asset through primary, secondary means. But on a bad day, they're obligated to give you whatever bid they think they want to give you or pass. I've had plenty of assets where dealers say pass. So having an agreement in which we're going to get 3 quotes a day is just more cutting edge.
Tom and Rob too. So, clearly we have Priv. Private assets have been in fixed income space for some time. But on the equity side, I think the only thing I can think of is the X over fund, right? Which has some allocation to SpaceX. What's your take on a kind of Priv-like product coming in the equity space, or somebody saying, hey, you know what? The VC Open 50 or 20 are where we want to be. Can you talk a little bit about what you're seeing in the market in terms of development, in terms of product development?
Yeah, I think, there's, if we think about this in general, there's investor demand for this. There's a lot of investor demand in the sort of mid-market retail accredited space that want to get access to the bleeding edge of innovation, which is predominantly centered in these private companies, and equity is the way to really access that. So there's a huge amount of demand. We see that every day, but there are real challenges in actually bringing this to market. And there are challenges that Jim's solving. At State Street with Priv, there's the challenge of price discovery for like a daily, liquid solution, and there's the underlying liquidity. These are illiquid assets, and so you mentioned an example of one ETF which does have, I think, about a 10% allocation to private shares of SpaceX. That's the rest of it is public equities. They're operating under the 15% illiquid asset rule in ETFs. So they can hold, an ETF can hold up to 15% illiquid assets. That's what they're doing. I think it's interesting to see. I don't think it's a particularly, it's sort of the green shoots, I guess, as well in this space of someone trying it. It's working. There is a way to get exposure to SpaceX through a public vehicle, which is great. But I think the industry has a long way to go. So the conversations we're having with issuers and people in the industry is, crossover funds, crossover indices is one angle where you can blend the liquidity, similar to Priv, of holding, some pool of liquid assets and then the remainder in privates. ETFs are constrained by the 15%, the liquid asset rule. And so there's potentially innovative conversations like what Priv has done in terms of finding dealers that will provide liquidity on these assets. I think, that is potentially one angle, but it's obviously not as developed as the credit market. And so there's probably a larger gap to bridge. But particularly crossing it with, having a crossover structure is definitely a way to get these assets in. You could think of some form of index like the S&P 500, but including both public and private companies. You would probably see an allocation to private sort of in that range that would be under the ETF rules. So there's many options. There's also obviously going through other wrappers, which I think is like being explored, and potentially these are more suitable given the liquidity constraints of the market. But I think if you take it back, there is absolutely demand. We see it every day, and it's just some structuring to get it out there. This is a large asset class. There's over $1 trillion in market cap, as I mentioned. It makes sense that you should be able to build these liquidity, and I think it takes innovative steps and bold moves like what State Street's done with Priv to actually to get this out there. The other driver is also returns. We have seen the NASDAQ, S&P indices this year remaining pretty flat. Our index of these private companies is up 25%. And again, this is those touching earlier in the day on different sectors performing. The NYSE VC index is really tilted towards AI. And AI, companies like OpenAI, Anthropic, Perplexity, xAI, these are all some of the largest holdings of the index, are at the forefront of the AI revolution. These are the model, the fundamental model companies, and they are really driving. There's a tremendous amount of investment in these companies. They're not only investing in the software, but also the hardware, building data centers, et cetera. And there is a huge growth in this sector. It's actually quite difficult to get exposure to this in public markets. And I think this is what's driving a lot of interest in this space as well. You could hold, Google, Alphabet, Microsoft, Meta would probably be the play. But they are very diversified companies. Actually, they're not generating much revenue or anything from these AI investments. It's a very small part of what these companies are doing. Looking in the private markets, you can actually get to the source of where this investment is happening. And if you believe that AI is going to be the revolution that many out there say, it's very difficult to get exposure. And I think it's shown in the numbers. So 25% up this year. versus a flat market. If you look over 12 months, it's actually around a 50 to 60% increase in the index value. It's been a real rally in this space, and a lot of investors have missed out on that with S&P at sort of 15% or 12 to 15% over the last 12 months. So be it hype, is it a bubble? Is it hype? Maybe, but there is a true revolution going on in AI, and this is completely shut off to most investors.
Yeah, and to talk a little further on that point, so clearly, if you want to get access to private assets as an individual investor, number one, you need to be qualified, right? You need to be equipped. And then the other thing too is that when you go to these venues, like public markets are set up for the investor. They're set up for the public. So you go there, there's liquidity. You basically, assuming you can get the right spot on the book, you're going to get execution. And if I put my order in at the NYSE or NASDAQ, it's going to get filled because they can't not take my order, right? Private markets are very different. The model's flipped, right? So not only do you have to be equipped, but the providers of these shares can make the decision not to trade with you. So just because you show up, it doesn't mean you're going to get filled. And that's a big, and they can set liquidity windows and they can do all these things that we take for granted in public markets. That's just not how it works in private markets. So, to Tom's point, getting that exposure as an individual investor is tough, right? So to the extent that, the ETF wrapper can do for private assets what it's done for, physical commodities, futures, options, multi-leg option positions, swap exposures, what I like to call package reg T trades, right? Margin trades. That's kind of where we're hoping that this all goes, right? So it's kind of I hate to say the last question because I know we're going to have more. But one of the things that I wanted to talk about, or at least have the panelists talk about, and this is to all of you, the structural elements about how we put private assets into an ETF wrapper exist, right? Whether it's direct ownership with shares, via a swap, via a special purpose vehicle. There's a lot of different ways for this to happen. But what about on the cap market side? And I know we've talked a little bit about the availability of data, but again, getting back to liquidity and price discovery, can you talk about what you all are seeing with regards to those two? And I know this is kind of an equity tilted question, but if you want to reiterate what you said about the markets and how you access them, what are you seeing? What's kind of the next step, or what do you think needs to happen so that we can get to a point where regular way liquidity is? We don't even have to talk about it because it's there.
Sure. Yeah. One of the thoughts that I have in that space would be the structuring of the vehicle is really important, right? As you mentioned, you can have your 40 Act registered 33, 34 hybrids that are more of these interval and tender fund vehicles that'll provide access to the space in a really efficient way. But then you will have some liquidity constraints as the end investor that may be restricted to quarterly or semi-annual. So providing enhanced liquidity mechanisms for vehicles in those structures where investors may be able to get out, intra liquidity window, whether that be in a more organized exchange manner or on different ATSs that would exist, that could definitely be one viable path to provide access to the asset class in a diversified fund structure, but also have enhanced liquidity. The other area that I could see the space growing into would be within the ETF wrapper, potentially being able to enhance instead of 15%, maybe you can go up to 20, 25. That gives you a more meaningful exposure to the space. That's more in line with what a lot of the wealth managers are coming out with today around proper allocation to public equities, fixed income, private equity, and private credit, you could start to create different portfolio constructions within these wrappers that give the end investor the liquidity they're looking for with efficient access to the product. So I think this space will see a lot of advancement and new regulation coming down that make it more accessible and more investor friendly. We're already starting to see some of that with the conversations going around accredited investors and the thresholds and what's required to meet those as an example.
You want to comment?
Yeah, I think that's an important point. I think another, it's about the evolution of the market, really, is what we're focused on. And it's about bringing all of the players to the table that need to be there in order to make this work, in order to provide liquidity, in order to provide transparency and sort of price discovery. What we've really focused on initially is index and price. We still have a long way to go to get our full ambition of creating a full consolidated ticker, or tape D across the industry. That requires the whole industry to work together. There's competing pressures as to why they would or wouldn't. But as a whole, our position is, in our view, which most follow, is the more we can focus on adopting standards, working together, bringing transparency, we can rise all boats in this space. So that's a big focus for us. I think but it also requires other participants to come together, issuers that are willing to be bold and to sort of take the step into moving into new asset classes. People like Apollo with State Street, dealers, and the banks willing to work to provide liquidity on these assets. I think, again, is sort of the cart before the horse. If you don't have price discovery, a robust price discovery, how can dealers come in and actually make markets? And so, but all of these things in combination is what's going to power, in our view, the development of this market and make it into something that you can actually layer into a more liquid product like an ETF. And so that's what we're focused on. We're focused on trying to work with all the market participants, with shining the light to show how much opportunity there is here if we can do it right, and how good it would be for investors that are currently cut out of this exposure to be brought into it. And I think, obviously we've focused on our sort of own areas. We've focused on like late stage VC, but I think it's across alts, right? Where this is a phenomenon that there's, the same problems in, as you touched on, real estate. There's the same problems in other, art assets, etc. I think it's a phenomenon across the board. It's the same in private, credit, which is probably trailblazing for everyone else. It's probably the most developed in the private market space. But that's really our focus.
Yeah, I guess I would only add, I've spent a fair amount of time talking about the liquidity arrangement with Apollo, but I think importantly, it's an ETF wrapper. And when we look at the book, it's roughly 80% public-private. Strategically, we think over a cycle, 25% private, 75% public would be its overarching average exposure. But the ETF wrapper also offers other avenues of liquidity too. All that public exposure, corporates, mortgages, those can kind of move in kind. And so there's just all sorts of avenues and approaches here to amplify and deliver to the clients that exposure with plenty of liquidity behind it.
So one comment and then one question. The comment being, I guess technically it's two questions. So what comes first, the consolidated tape for private assets or the European consolidated tape? Okay, I guess you have your answer there. The second question that I had completely escaped me. So maybe it'll come back to me. But okay, so at this point, I'll venture out to the audience if there are any questions about private assets, about funds, etc. Yes, in the back there.
For for Priv, is there any risk as the product grows substantially? You have deployment issues with Apollo? Like, I mean, if they're having to put to work billions every single day or week, and given that I believe the secondary market for these private assets is typically quarterly, how do you deal with those deployment issues?
So let me make sure I understand your question. You're asking that if the fund were to grow to a certain size, would that create issues with Apollo's ability to provide daily liquidity?
Yes.
Yeah, I think, I think one of the things about the joint venture between SSGA and Apollo, it really starts at the very top of both firms, State Street Bank and Apollo. Their chairmen are the ones really connected on this. We believe that as the fund grows, that they'll be set up with capital to provide us what we need. They have a broker dealer that's on the balance sheet, Atlas, that they'll just have to manage along with the size of the exposure. I think from our perspective regarding the quarterly comment you made around liquidity, I think for us on these individual assets, we are getting quotes every day. We are getting struck from a NAV from an independent source every single day. And so we're able to kind of navigate and see where the prices are and continue as any active fixed income investor to have a sense of where fair value is for any asset that we own. The levels come in and we make choices around that in order to either deliver liquidity for clients that need it or utilize it to take advantage of opportunities. Does that answer your question?
And anybody else? Don't be shy. Oh, yes, please.
A couple of years, there's a lot of talk about tokenization of certain private assets because ETF structure was a little more complicated for such assets. Has there any additional work been done on that?
For those who didn't hear, the question has to do with tokenization with private assets.
Sure. So when it comes to tokenization and blockchain in the private markets, I think as the regulation evolves around what you can do with the blockchain, I think we'll start to see more proliferation in the space, right? All of the same requirements around transactions, reporting, custody, clearing, et cetera, still exist. These are securities. So being able to merge that in a capacity that's friendly with the regulators will allow that to really start to take off. There's, back office efficiencies you can get from utilizing the blockchain in terms of, seamless execution, transfer of ownership, tracking, et cetera. I think in time that will start to pick up more, but a lot of it's going to be regulatory driven so that we can actually leverage the efficiencies that the blockchain can provide.
Okay. Just scanning the room here for anybody else? No? Yes.
Can you speak to the accessibility across, let's say, the wirehouse platforms? Has it been easy? I know, I think may have been referenced here, that the allocations to privates are essentially going from, let's say, 5% to somewhere around 20%. But I know the buy-in generally has been difficult when it comes to some of the bigger firms in terms of onboarding products. I'm curious, maybe Jim for sure on PRIV, but maybe Tom too in terms of OpenVC. Curious kind of what your thoughts are there.
I think access, when we talk about the seed capital investment experience with Apollo, we had access to, like I mentioned earlier, we spent a lot of time with them, connecting with them, understanding where our fit was from a credit perspective and evaluation perspective. And, on the day of the seed capital investing, it was no problem. They've got plenty of opportunity and inventory for us to kind of work through from 4A2 all the way into the ABF space. And as I mentioned earlier, we're seeing every primary issuance that's coming through. So, at this point, we've seen no real issue. And I think it's part of the special connection we have with Apollo that we have access to inventory that's difficult to get elsewhere.
Was your question also around the demand coming from these investors?
Yeah, I recognize, particularly for OpenVC, that would probably be a very difficult process from a demand perspective. But curious in terms of where you think the opportunity is going to come from. going to come from maybe family offices, RIAs. I'm curious kind of what your thoughts are.
Yeah, so I think there's two parts to it. The one part is where is the demand, and then the second part is who can actually invest and write these checks, right? So we just did the first close on a private vehicle, which is tracking this index. That capital came from primarily family offices. So this fund was not distributed by wirehouses, et cetera. It was from ultra high net worth individuals and family offices, in the US and abroad. That is where they can actually access this. What we're looking to work on in the next wave is actually registered vehicles. Be it, the structure is yet to be determined, but we're sort of going through a process with a number of partners at the moment of trying to unlock vehicles that can be distributed by wirehouses, that can be on the the RIA platforms out there, because that is where there is a tremendous amount of demand to get access to this, and that is probably family offices already have allocation to alternatives. If you look across the board, family offices have a reasonable allocation to alts. They've been able to access it through private equity, private credit, directly, VC, over a long period. Compare that with RIA clients and that sort of wealth sector. It's very small. There's not many products that they can invest in. And that is, I think, where you'll see the focus of a lot of the large asset managers is really on this wealth channel and this space. You see BlackRock making big moves, really, and if you drill into what they're talking about, a lot of what they're talking about is distributing to private wealth, private assets. And I think, probably it's a big part of your strategy as well. And that's why
my roadshows have frequently been with RIAs.
Okay. So that's why you're seeing interest in Priv?
I think it's going to be the quickest path to interest. There's obviously a lot of demand. Did I interrupt you? A flow of thought there? I apologize. But ultimately, what we've heard is that when you stack up institutional and insurance companies, for example, and RIAs, the 40 Act wrapper is what RIAs are hoping people will see as a much better take-up versus interval funds, in which they have access to interval funds, but they don't love it. And so the ETF wrapper, they think, will be sort of a primary channel. I think on the insurance side, you need NAIC ratings, and so time will have to develop for the institutional side. But I would say my calendar's been pretty busy talking with our ETF wrapper, take advantage of a better take-up that we see in ETFs versus interval funds.
I would also just expand on that. I think one of the pools of capital that has been largely untapped in private markets has been self-directed investors. So like we've been partnering firms like SoFi and their brokerage team to bring different private market investments to clients, enabling efficient access. And I think that trend will continue to grow. Not every client has an advisor that could get them access to these types of deals, but they still may be accredited or they still may meet the thresholds of the product. So having an efficient pipeline into those pools of investors, I think, will be a differentiator for a lot of asset managers or SPV issuers that have different products.
I think we have time for one more question. Yeah, actually. Oh, okay. Here you go.
Well, I was going to say, Tom referenced my ETF earlier today, and actually the response to the question that you asked is that generally the wirehouses don't allow you in right away. In fact, it takes a while. It took us 9 months to get onto the UBS and LPL platforms. But generally, right out of the gate, retail investors can come through Robinhood and Schwab and Fidelity. So to answer your question, the wirehouses are the ones who come last. It takes about 9 months to a year, but we were very successful in raising money through these other channels.
Did you remember your question? Yeah, you had a question.
I did, but look at the time. It's not gonna.
Okay.
Anyway, you guys see, you'll have to come back next year when we have no. No, but that does kind of wrap up things. I guess the one thing that I would mention to you all is, looking at new products, looking at new indexes. Some of you from a quasi-tech field might know the phrase RTFM, which in this case means read the fantastic methodology. All right. So methodologies are on, or in the case of Priv, I guess it would be more of a pro, but on SSGA's website, OpenVC's website. Are you guys hosting the methodology, or is that on NYSE's site? Yeah, on NYSE's. Okay. So get out there, RTFM, and thanks a lot for joining us. So